Before investing in any company, it is essential to understand both the positive and the negative aspects of the business. This means looking beyond personal bias and examining both sides of the argument. Today we will take a close look at a bearish opinion piece about Palantir Technologies, and then I will share some of my own personal views at the end. The reason for doing this is simple. By understanding both the bullish and bearish points of view, investors can make more informed decisions that are based on a broader perspective. Even if you personally believe Palantir will keep going up, you should still be aware of the risks that others see. With that in mind, let us dive into the details. Palantir Technologies is currently priced for absolute perfection. However, there is no such thing as perfection in the stock market. Over the last 30 years, investors have been repeatedly drawn to certain breakthrough technologies that dominate headlines and attract massive amounts of investment capital. These have included the rise of the internet, the breakthroughs in decoding the human genome, the excitement surrounding blockchain technology, and the hype over the metaverse. While each of these moments attracted intense investor enthusiasm, none have inspired the same level of widespread excitement as artificial intelligence is doing today. PwC, in its report Sizing the Prize, estimated that artificial intelligence could represent a global opportunity worth $15.7 trillion by the year 2030. This figure includes both productivity improvements and the effects of increased consumption. Such a massive potential market has been a driving force behind Palantir Technologies' sharp climb in value. As of August 10th, Palantir had risen to become the 19th largest publicly traded company in the United States, with a market capitalization surpassing $443 billion. From the start of 2023 to that date, its share price had surged by more than 2,800%. To better understand this scale, consider that Palantir is now more valuable than Johnson & Johnson, which had an uninterrupted run of 35 consecutive years of adjusted operating earnings growth before the pandemic disrupted it. It is also larger than Costco Wholesale, which has experienced only a handful of down years in the last 2 decades, and bigger than Home Depot, a leader in home construction, remodeling, and repair. If Palantir's share price were to rise just 2% more, it would surpass ExxonMobil, which holds the title of the largest publicly traded energy company in the United States. Such rapid growth is impressive, yet it also signals possible danger. Palantir's rise from being just another technology company to one of the most important businesses in its sector in only 2 years was no coincidence. This success reflects the company's ability to establish and maintain competitive advantages that are not easily matched. The company's leading business unit is called Gotham, a software-as-a-service platform powered by artificial intelligence and machine learning. Gotham is designed for government agencies, helping them collect and interpret large amounts of data, as well as plan and oversee military operations. Gotham typically secures multi-year contracts with the United States government, providing the company with a reliable and predictable source of cash flow. The other major business unit is called Foundry. Like Gotham, it is built on artificial intelligence and machine learning, but it serves commercial businesses rather than governments. Foundry enables organizations to better understand their own data, allowing them to streamline and automate their operations. Being newer than Gotham, Foundry has more room for faster growth. What sets Palantir apart from many competitors is that neither Gotham nor Foundry faces direct large-scale competition for their customers. In the world of investing, companies that are considered irreplaceable often command higher valuations from Wall Street. Palantir has strengthened its position by becoming consistently profitable much earlier than analysts had predicted. The company has routinely exceeded even the most optimistic expectations for revenue and profit growth. While there is no denying that Palantir deserves a premium valuation given its advantages, there is still a reasonable limit to how high this valuation should go. Critics argue that Palantir's current situation has many of the same warning signs as a fragile structure that could eventually collapse. History has shown that stocks can remain overvalued for longer than short sellers can survive. However, in the not-too-distant future, the nearly vertical climb of Palantir's share price could end suddenly and sharply. One of the key challenges ahead for Palantir will be broader market conditions. The Shiller price-to-earnings ratio for the S&P 500 recently reached its third highest level in 154 years of recorded history. When valuations become this extended, history shows that a bear market is likely to follow at some point. In a market downturn, the stocks that had risen the most tend to be hit the hardest, and Palantir could be one of the prime examples. It is also worth noting that no major technological advancement in the past 3 decades has escaped a bubble and a sharp correction. Whether it was the internet, genome mapping, or other innovations, investors often overestimated how quickly the technology would be adopted and how useful it would be in the short term. Even though companies today are investing heavily in artificial intelligence systems, early results indicate that many have yet to fully optimize these systems or generate meaningful returns. If an artificial intelligence bubble were to burst, Palantir would likely be one of the first and hardest hit targets. Valuation metrics are another area of concern. Before the collapse of the dot-com bubble, some of the most valuable companies had price-to-sales ratios between 31 and 43. Nvidia, a leader in artificial intelligence hardware, reached a price-to-sales ratio of 42 last summer. Historically, such levels have marked the upper limit for large-cap companies. Yet as of August 8th, Palantir's price-to-sales ratio was 137. It means that investors are paying 137 times the company's trailing 12 months of sales, which is far above anything that has been sustained in the past. Even if Palantir's share price remained unchanged for the next 4 years, the stock would still be valued at 116 times expected earnings per share and 38 times projected sales. Those figures are right in line with where previous technology bubbles have popped. There is also the matter of Gotham's future defense spending. Contracts are currently secure through 2028, but beyond that point the outlook is uncertain. While the current administration has made defense spending and internal artificial intelligence development a high priority, political changes after January 2029 could shift those priorities significantly. Analyst opinions on Palantir vary widely. On the lower side, Mizuho Securities rates the stock underperform with a target price of $94 as of May 6th, 2025. Jefferies also gives an underperform rating with a target of $60 as of February 19th, 2025. RBC Capital Markets is even more cautious, assigning an underperform rating with a target of $40 as of February 4th, 2025. On the higher side, Piper Sandler rates it overweight with a target of $182 as of August 5th, 2025. Wedbush Securities rates it outperform with a target of $160 as of the same date. Loop Capital Markets rates it a buy with a target of $141 as of February 19th, 2025. Some other stock reporters have even suggested possible targets of $190 and $200. Even though the author of the original opinion piece has a bearish outlook, Palantir still has considerable potential. The company continues to show strong growth and technological leadership in both artificial intelligence and data analytics. While it faces challenges such as slower international market penetration and its high valuation, Palantir's advanced solutions and its position in critical sectors give it a strong base for future opportunities. With a financial health score rated as great by Investing Pro, strong liquidity, and moderate debt levels, the company appears to be in a solid position to pursue growth strategies. In the coming years, both investors and analysts will be watching closely to see if Palantir can maintain its growth trajectory and prove that its premium valuation is justified. In short, Palantir Technologies has skyrocketed over 2,800% since early 2023, becoming the 19th largest publicly traded company in the United States with a market value above $443 billion, driven by excitement over artificial intelligence's estimated $15.7 trillion global potential by 2030. Its main platforms, Gotham for government data and Foundry for business operations, face little direct competition and have helped the company beat growth and profit expectations. Analysts' price targets range widely from $40 to $200, showing the divide between bullish and bearish outlooks. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.